While debt securities are accounted for essentially the same way, regardless if they are trading debt, available for sale debt, or held to maturity debt, the way that you classify your equity securities changes the methodology you have to use to account for those equity securities. If you own less than 20% of a company, you are allowed to use what is called the cost method. And the cost method essentially treats it purely as an investment. You would put it on your books as an asset to record the receipt of any dividends you had as revenue, and if you chose to sell it, you would remove that asset from the books and recognize any gains or losses. The equity method is used if you have what they call significant influence over another company. If you own between 20% and 50% of the company, you have to use a different methodology to account for, which you will see in some subsequent slides. And then if you own more than 50% of a company, you need to, as they call it, consolidate, which means you're going to keep separate books for that entity that you own more than 50% of. But when you report your numbers, you are going to roll all of the numbers of that business into your own numbers and then take out the portion which you do not own. And here I have a balance sheet for Apple from the year 2015. Well, Apple owns a lot of other entities, and one of them being Beats. They bought out Beats in 2014, and as you can see on their asset section, there isn't any line that says assets from Beats. And the reason being is they have rolled them into their financials. So Apple would take all of the cash, short-term marketable securities, inventory, etc. that is related to Beats Audio, roll them into their numbers and report as though they were one giant company, because since they own more than 50% of Beats, they essentially are. Let's go on to using the cost method. So here we are going to do this for a company which owns less than 20% of the other company's stock that they are investing in. On March 1st, 2018, Smart Touch Learning is going to acquire 1,000 shares of stock in Yellow Corporation, and they're going to buy those shares for $26.16 per share. Well, since they own less than 20% of Yellow's voting stock, their outstanding common stock, they get to use the cost method and put this on the books as an equity investment for, as they call it, their basis, which is the amount that they paid initially to acquire those stocks. So they're buying 1,000 shares at $26.16 per share, which means they're paying $26,160 to buy ownership in Yellow Company. We're going to put that on our books as an equity investment, as an asset account, which is typically going to be a non-current or a long-term asset because stocks do not ever mature. And we're buying this from the other company, which means we are going to hand them cash. We need to decrease our cash account by that same amount, at $26,160, in the journal entry to record the purchase of investment in Yellow Corporation's stock. Just like you would receive interest from bonds, equity investments will cause your company to receive a series of periodic payments, this time in the form of dividends. You own at least a small part of that other company, and when that company has profits, as an owner of that company, you are entitled to a portion of those profits. So if Yellow Corporation declares and pays a cash dividend, and it is 16 cents per share, and they're doing so on June 9th, 2018, Smart Touch is going to record the following entry when they receive that cash dividend. They're going to debit cash. They're the ones receiving money in this case for 160, and they're going to list that as dividend revenue. And you can find that on common shares by taking the rate which was declared and ultimately paid, in this case 16 cents per share, and multiplying it by how many shares you own. So if they're getting 16 cents per share for the 1,000 shares that they own, they're going to receive 160 bucks. So we're going to credit dividend revenue for that 160 bucks in the journal entry to record this cash dividend. A question that I get commonly asked is, we have to put a liability on the books for our own dividends. Like when we declare a dividend, we call it dividends payable. Why don't we have dividends receivable? And my answer to that is, you can if you want. You could have an account on the date of declaration to record the dividends you're going to receive in the future, but it's not common practice. And the reason for this is, by the time you put your numbers out into the public, you may not, have all of those dividends eligible to be received anymore because you've actually collected them. It takes time for your financials to get in the hands of the people that are going to use your information. So keeping a dividends receivable account isn't really increasing the quality of information that you're showing to others. You can if you want to, but most companies just wait until the actual date of payment to record that revenue. What happens if a company sells its investment in another company? Let's say that on July 15th, 2018, SmartTouch is going to sell 800 of those 1,000 shares they just previously purchased, and they're going to receive $25,000 in total for the sale of their ownership in Yellow Company. Well, they're receiving $25,000. How much profit are they making? We can find that by taking how much they're receiving at the time of sale and subtracting out their basis, the cost that they paid to initially acquire that stock that they're disposing of. So if we went back a couple of slides, we can remember that we bought those shares of Yellow Corporation for $26.16 a piece. Our basis, therefore, on these 800 shares that we are selling is 800, the number of shares we're selling, times what we paid for them originally, $26.16, and that's $20,928. So if we're selling these shares for $25,000 and we paid $20,928 for them, we are making $4,072 in profit. And because for our company, for SmartTouch, we're a company that makes technology, we're not an investment firm. That is not something that is typical of our normal operations. We can't record that as regular revenue. We're going to record that as a gain. So the journal entry overall to record the sale of an investment which you had previously purchased for a profit is a debit to cash for the amount that you're receiving, in this case $25,000. A credit to equity investments to remove that investment from your books at the basis of that stock, which again is usually, if you're profitable, at a price less than the amount that you're receiving, $20,928 in this case. And the difference goes into your gain account. The slide calls it gain on disposal. I have always booked it as gain on investment sale. As long as you have some terminology in there that makes it clear to people to know exactly where that gain is stemming from, I'm not picky about what you call it. So in that case, this entry is $4,072. Let's go through and do some more journal entries for a no significant influence equity investment. On October 26, McFly Motor Company is going to purchase 100 shares of Doc Brown Boots common stock, and they're going to do so at a basis of $35 a share. Doc Brown Boots has 1 million shares outstanding, so their 100 shares is just a drop in the hat of the total voting stock of Doc Brown Boots. They have zero significant influence over Doc Brown, which means we get to use that cost method. So we're going to record the purchase of this asset under our equity investments account. And we're going to put it on the books for the price that we paid to acquire this asset in the first place. We're buying 100 shares at $35 a piece, which means we're going to spend $3,500 to acquire this investment. We put it on its historical cost. We debit equity investments for $3,500. We're paying cash to acquire these shares of Doc Brown Boots' stock, which means we're going to credit cash to decrease our cash account by the price that we're paying, that $3,500, and the journal entry to record the purchase of 100 shares of Doc Brown Boots common stock as an investment. Later on, hopefully when Doc Brown Boots is profitable, since we are part owners of this company now, they're going to send us a share of that profitability in the form of dividends, and on January 15th they're doing just that. They're paying dividends on their common shares at a rate of 40 cents per share. Well, we own 100 of them at this point, so our 100 shares at a rate of 40 cents per share means we are entitled to receive a $40 payment from Doc Brown Boots. And they're paying us, so we're going to record that as cash for the amount we are receiving, which is $40, and we are going to credit dividend revenue in this case for that same $40 in the journal entry to receive a cash dividend from Doc Brown. Later on, we are going to sell a portion of our ownership in Doc Brown Boots. We're selling 10 of those 100 shares that we previously purchased, and this time we're selling them at $45 a share. And that's good for us because if we back up a couple of slides, we bought these shares at $35 a share originally, which means our proceeds from the sale is going to be $450. We're selling 10 shares for $45 a piece. Our basis in those shares that we are selling, our historical cost that we acquired them at, is $350. Those 10 shares cost us $35 a piece when we bought them, which means we're turning a $100 profit on the disposition of this investment. That's our gain. So when we record the journal entry to dispose of a portion of our ownership of Doc Brown Boots, we're going to debit cash for the amount that we are actually receiving from selling it, our cash proceeds, which is $450. We are going to credit equity investments to remove them from the books, again at the basis that we paid for originally. Those 10 shares cost us $35 a piece. That's $350. And our profit on the sale was $100, which we're going to record as a gain on the disposal of these equity investments. In the journal entry to record the sale of our part of our investment in Doc Brown at a gain.